ask though, like just to sort of nudge the conversation in a slightly different direction. I'm just wondering, because this is all too positive, and all the good we can do. Let's move it to.
I tried to go negative early. They wouldn't go.
I know you
there,
did,
so.
and there's just too much positivity in the conversation. So I'm just wondering, given all your observations, you've had what 10, 15 years of observing the interaction of humans in markets, and I'm just wondering what that has done to your belief in the efficient market hypothesis.
Oh, I think it's gotten to the point where I'm like, the least amount of time I can spend thinking about it is the most effective thing I can do. Just like, I remember having this realization years ago. It was, I think I have a portfolio worth $100,000, me personally, my own money. Right. And
you have $100,000.
Can I sign up as a client?
Can I borrow some money?
And I remember thinking, like, what's like a really good alpha number that like any manager would be super proud of, and like let's just pick 2%, right? So on my $100,000 portfolio, I can generate $2,000 a year, right? Like, come on, dude, that is not a good use of your time. You have other skills and things that you need to be doing, and so just there, that's sort of like, stay focused on like whatever differential skills you have, where you have an advantage, where you're actually going to get like a payback on an hour's worth of your time, and do that. And just like, don't worry too much about the specifics of it. I care a lot that, I'm in a relatively good low cost portfolio, but you could put me in a little bit of value. You could put me in like whatever. And as long as it wasn't anything crazy, I'd probably be okay with it, because I have other stuff to worry about, because it's not really.
No, but you made a leap there that we didn't need. You made an extra leap that we didn't need to leap. Like, what has your experience in observing investors led you to believe about whether or not markets are informed by rational expectations and profit-seeking actors who are constantly seeking an edge? Like, all of the fundamental tenets of efficient markets, what has your experience in observing investors led you to conclude about that in general, without sort of whether or not it's meaningful for you to spend time thinking about deviations from efficient markets? Just in general, what have your observations informed?
So I'm gonna use the Tesla example. Is Tesla like overvalued? I know nothing about the car market or like any of this stuff. I also don't know what the future is going to hold in terms of electricity and so on. But I know that my dog walker is buying Tesla on Robinhood. And what this ends up making me think about is like, I don't even know that he's wrong. And if enough people like him think and act the way he does, then Tesla's going to continue to be overvalued for a very long time. So I think one of the things that I've come to is that I think it's called the weak form or the Grossman-Stiglitz form of like market efficiency, which is not that the market is right. It doesn't have like the right price, but that doesn't mean that you can do any better than it, because if the market's consistently crazy and going all over the place, then like you're trying to predict crazy people, right? So that's where
I'm not trying to trick you into suggesting that people should seek alpha. I know you're not going to say that. So that's not where I'm going. I literally I'm just genuinely curious, because every year that goes by in my career leads me further and further away from efficient markets, just purely in terms of observing investor behavior. And I agree, generating excess returns off misbehavior is a completely different question, and it's hard. I'm just wondering, I mean, this castle is built on a swamp that assumes I agree, like weak form efficient markets, and I'm wondering whether anything are the errors random, so that they would cancel each other out, or like are there qualities of the systematic interactions that investors have that lead you generally in the direction of efficient markets?
I genuinely don't know. Like it's just one of those like big questions that the one thing I think of sometimes is like, is if people are all biased, but in different ways at different times, a system that aggregates them up in some way is going to be, I don't even know if it's right, but it's going to be pretty random and noisy itself. So yeah.
So we probably agree that the market is efficient in that it clears trades in the moment. So that efficiency we can probably agree on, but that efficiency, or the inefficiency in that is that there is some herding behavior, that there is a deviation from, again, what would be normal metrics, which we don't know because they change through time. So I agree. This is a hard. I'm obviously in the very weak camp. Is in they clear trades. The market is efficient because it clears trades today at whatever price it clears trades at. Is that the long-term value? We don't even need to
invoke equilibrium. It literally is just, in order for markets to be efficient, it assumes you've got independent actors, right? So if the error terms are uncorrelated, it means that all of the actors are acting. They all have error terms, but the error terms are not manifesting in the same direction at the same time for the same reason, right? So it requires independence. As we move into an increasingly connected and socially aware and mimetic society through social media and faster connections and 24-hour news, et cetera, is it even remotely reasonable to assume that investors are acting with independent error terms?
So here's where I want to go with this, and I love this. All right. Ramp Capital on Twitter posted today, imagine if you could see who you were trading with whenever you posted a trade, right? And I want to take this a step further and say, imagine if they had to write a little memo. Betterment customers do this. Like when you go and you make a withdrawal or you make an allocation change, you can have an investing journal on it. And so like you see stuff like, I'm withdrawing $2,000 to fix my truck, right? Imagine if everybody in the market did that and we all saw who we just traded against and like what their purpose was or whatever it is to see these clearing trades. I would put money on you would see like 9/10 of stuff being like, I need some money for my truck. And the other guy is going to be like, over the next quarter, the Fed is going to do this, which is going to push this in this direction and then compensate with that. And therefore I'm putting this trade on and taking your money and I'm going to beat you. It's like just people playing two fundamentally different games where some of them are trying to look at like that the information in the market. And other people are just like, I just invested in my retirement fund for 40 years and now I'm taking money out. I have no view about markets whatsoever. So that's sort of like,
because price is set at the margin, if you've got a large number of investors that are trading randomly, so in other words, for reasons like I need money for my truck or, whatever, they're purely idiosyncratic, they'll all cancel out. And the only investors that affect price are those that are seeking an edge, right? So we can discount those random errors. And the question then becomes, are the other investors that are actively seeking an edge independent? Are they making independent decisions, or are they influenced by, as Mike alluded to earlier, in general, a herd mentality? If they're not independent actors and rather they're acting on feedback mechanisms and reinforcement, then, I mean, the efficient market hypothesis is actually, again, incoherent on its face, right? So I just think we all sort of, and increasingly it is true that we all operate on this idea that we should all invest passively, and no market in history has validated that assumption more than what we've observed over the last 6 or 8 weeks. But I just think it gets to what Mike was asking earlier, right? We're trying to do the right thing, right? You're trying to nudge investors to do the right thing. What is the right thing? Right. That is a fundamental question that nobody answered here. We all sort of danced around it. Mike tried to sort of get at it. It's not your fault, I'm not blaming, but at its root, this is something that we all end up having to answer as a question. It's easy to say, assume efficient markets, therefore passive portfolios, et cetera. But to dig into this is hard and it's messy.
It's also not your role, right, Dan? Like you're not a portfolio manager, so it's a tough thing to be asking. Dan, I think. And
I'm not really. I'm not trying to put Dan in the corner, right?
No. This is free.
You're asking me? Okay, here I go. Sorry, Yeah,
I think it's also interesting though, because it's
go down that
like,
route.
What's a good way of putting this? How many dimensions do you guys think string theory needs in order to be true?
5?
Exactly.
What is
right? Like
7?
What is
empirical data from a few
suggested?
very focused experts who really know about this stuff and study it and have strong opinions for one reason or another. The average person has no opinion about like that stuff. And they also have no opinion whatsoever about if, X is overvalued and Y is undervalued, and they don't need to go out and have those opinions. It's good to have people who are focused on it, and even better if they're kind of like their disagreement breeds trades and price discovery and everything. But for most of us, like that is such an esoteric question that doesn't, I don't know, but there's not a real return on having a strong answer to it for each individual. So it's like, I don't know.
Well, this is the point, though. I do think this is the problem. At what point is it 60 times future sales that the S&P has no future returns for your retirement fund? And do you have any implication or understanding of that for your savings? Like you have none.
And what responsibility do we as advisors have in order to recommend things that are actually probabilistically reasonable to expect that they're going to meet financial objectives, right? Like, it's easy, right? Because we can all sort of just assume the default option now. It didn't used to be this way, by the way. 10 years ago, advisors actually had to make decisions because it wasn't just assumed that everyone was going to invest passively. It seems easy now because everyone's adopted the passive framework, but there was a time when people had to think about
which
this.
Is stuff. Not passive, right?
Of course,
right. So we have to think about what passive is. The fund flows are following performance. They're not following passive. Passive would be a global market portfolio, and then you'd have to figure out some sort of way to encompass private equity in your portfolio, which there are ways in which you can access that. But again, that would be true passive. We have.
Totally. I mean, we're embracing passive because passive has done well recently, right? Like if we had just come out of 1989 Japan, and we're Japanese, the market cap weighted topics over the next 5 years was not going to attract people into passive market cap weighted Japanese equities, right? Market cap weighted US equities have done very well recently, and therefore passive is the only way to go. So to kid ourselves into believing that we're moving in this direction because of some coherent intellectual framework, I mean, it's fine. It's a good narrative, but the reality is we're all return chasing.
Well, let's let the data speak for itself. If we thought of a very large robo advisor who is advising a lot of portfolios in America, and we were to ask that person how many of those portfolios are truly globally positioned, as in they are global without a US bias, what would percentage of those portfolios be?
Yeah, and I didn't want to give Betterment a nod here because I think you and I chatted about this on our podcast, Dan, and I know you guys do your best to try and actually get closer to a global market cap weighted, truly in a classical sense, passive portfolio, right? Which is admirable. And maybe we can sort of move off this topic and talk about
because I think one of the key things is understanding what an investor, going back to the you got to have faith, right? What an investor is likely to stick to long term. I mean, this is kind of like the letters back and forth between Ed Thorpe and Samuelson, right? Ed Thorpe was all about the Kelly criterion as being the best possible way that you can compound wealth. The Kelly criterion, the way he was applying it, meant that at times you could have 95% drawdowns, but you would never lose all of your money if you hadn't done right? Whereas Samuelson said, you're out of your mind. This is about a utility curve. Every investor has a different utility curve that you need to take into account. And there is no way that a perfectly mathematical equation that has that type of drawdown is going to get you to the goals that these individual investors need. So, it's certainly, there's a balance between these two things of whatever we think is mathematically optimal versus what is behaviorally optimal. And that home country bias is a very real one as well. We've talked about this before, Mike, right? Where you have the robos in Canada saying that the optimal portfolio for investors is 60% Canada equities, and the rest is international when you're in Windsor, Ontario. But then you cross that bridge over to Detroit and all of a sudden the optimal portfolio is to have
different.
a 60% U.S. equity-based portfolio. And this is utility. This has got nothing to do with optimality.
Well,
right?
And I agree that is true.
It's a cross between behavioral optimality.
Yeah.
It's just that even a home country bias is materially informed by recency bias, right? Like Mrs. Watanabe, the Mrs. Watanabe phenomenon in Japan, where 10 years after the peak in the Japanese bubble, the Japanese speculators or the Japanese investors at the margin didn't put $1 to work in Japanese equities, right? They were offshoring. If U.S. equities were to underperform materially for 10 years, then it would completely undermine the domestic equity bias and the passive equity phenomenon, right? It is a phenomenon that is created by our experience. And if in a different experience and in a future that has a different trajectory, we will express different biases and create completely new narratives to justify whatever default options we put in place at that time. And these will change over time. But to frame it as some sort of universal truth or universal reality, I think misses the point and also doesn't allow you to change your mind over time, right? So you don't want to get too married in one paradigm.
Right, you're just going railing against efficient markets and capital asset pricing model and saying that is the truth. That is an academic axiom, which is not true, right? What is true in the optimal mathematically? There is no truth that any one of us can come to terms with.
I agree.
Yeah.